Good morning, everyone. I'm very pleased to have Alastair George, Edison's chief strategist, with us to run through his current thoughts on markets. Alastair, you've changed your outlook more often than usual recently. What's been driving that?
Well, events have been moving fairly quickly, and so have market valuations. Just to recap, we came into this from a cautious perspective as post the enthusiasm for that Brexit deal in the UK, for example, and the resolution of the US-China trade war, if anyone can remember that. Market valuations had got relatively, got towards the upper end of their ranges, shall we say, by January. So went into this cautiously, saw the data coming from China in terms of the epidemic there. But then as markets woke up to the reality of it, we got to a point in March, I think, where market valuations were very much liquidity driven. And deeply discounted, certainly in the UK and in the mid-cap space, with the market down about 45% from the high. And at that point, we shifted to neutral and then to an overweight position. It looked probably a little bit more, it felt more aggressive at the time than maybe it looks now. But now we're back to neutral because actually the lockdowns have played out as we expected. Across the world in terms of flattening the curve and reducing the number of infections. Market valuations are cheaper than they were, but we're also looking ahead to some significant damage to corporate profits and in particular in certain sectors over the coming quarters. So at the moment we're neutral outlook on equities, possibly looking more for specific sectors rather than blanket market exposure at this point. And the volatility in the environment and market valuation has been driving those changes in the outlook for equities.
Do you think valuations are at risk from further sharp declines in earnings? We saw a sharp decline in global earnings through March, but do you think there's a lot more to come?
I think that the initial wave of downgrades has come through with something like 20% being locked off forecast for 2019. But I'd also say that when you're looking at consensus earnings expectations, they're not especially good at taking account of exceptionals, one-offs, events like these. What we have seen is that the pace of downgrades has slowed. And so we're past the inflection point there, if you like. I think we're now looking at moving past the lockdown. The economic data is likely to improve modestly as lockdowns are released. So in the very short term, it's the rate of change of downgrades rather than the absolute level which markets will focus on. And I think there's a degree of stability there. But coming through the second half of the year, we actually still have a fair amount of uncertainty as to exactly the form of the restarting of the economy, which could have further implications for certain specific sectors, I'm sure.
So how do you think investors should respond to the transition out of the lockdown? And how do we start the economy from here?
The response, let's take the question in reverse order, I think. In terms of restarting the economy, the governments worldwide have been a very challenging task in balancing the control of the epidemic with the desire to restart the economy and have sufficient demand in the economy to avoid a massive surge in unemployment. So balancing when exactly furlough schemes will be withdrawn to avoid people being made redundant will be important, as well as looking at the costs of those. Exactly the nature of the social distancing measures which will be required and whether or not schools are open, whether bars can open or there has to be table spacing in restaurants, whether the middle seat has to be vacated on an airline, those are detailed questions which will have a big impact on the profitability of certain sectors and also on the demand for those services. So that's where the uncertainty lies. Of course, the uncertainty in terms of whether lockdowns have worked is now behind us, because in terms of the strict definition, which is that they've reduced infection rates, they certainly have. So looking forward, I think investors are going to have to piece together and come to a view on just how much social distancing is going to be required over the next 3 quarters, just how much impact that'll have on demand and unemployment, and how they should carefully consider their sector allocations in the process.
So I guess all of this is why you're not more positive on equities at this stage?
Yeah, I think valuations are definitely discounted from where they were before, but I think there's a balance there between some really poor economic data which is going to come in coming quarters and where valuations are now. And also I'd highlight that you've seen something like a 50% retracement from the lows across most of the major markets. So the valuation argument which was there as recently as the 20th of March is not there now.
Right, so just finishing off, what will be the longer lasting effects of this pandemic, do you think?
I think the other thing which people should be aware of before diving into equity markets with both hands as these lockdowns are released is that the cost to government balance sheets of this epidemic, it's going to cost something in the region of 15 to 20% of GDP in the UK, for example, and that's not necessarily a problem. But where you've got the southern European nations, and I do write about this in my note, which both have higher debt to GDP ratios and also have increased exposure to leisure and travel in their economies, that's an open question for me for the moment as to just how much support will be available and whether or not we'll see some further issues there which were successfully suppressed following the Eurozone debt crisis of 2012 or 2013. So that I think is just one of those risks for the longer term which people should keep aware of, and also the strength of the gold price can't be ignored as we see interest rates now forecast to remain very, very low for a further period of time.
That's fantastic. That's a really helpful update, Alastair, and I look forward to catching up with you again next week. Thanks very much.
Thank you, Nicky. Goodbye.